It's great to be invited to actually get out and enjoy an open forum again. Dr. Roubini, always great to get your input. Nouriel, I know that you gave the audience your macro outlook this morning. So I wrote down here, you and I, we had a coffee yesterday afternoon, and I walked away and I wrote down MMI, a mild market inflation shock. Just remind the audience of where inflation is going to, because there's been a jolt in the bond market and the equity market. So let's just set the stage. Where does the jolt in inflation get to?
Well, as I pointed out this morning, in the short run, of course, there are a number of supply bottlenecks. They are in goods markets, they're in labor markets, they're in transportation, in the energy sector, in services. And we've seen a significant pickup already in inflation. US headline inflation is above 5%, core inflation is close to 4%. Now, the view of most of the policymakers like the Fed and of most of sell-side research, say JP Morgan, Goldman Sachs, is that this is just a temporary increase in inflation and is driven by, one, some base effects, and two, by these temporary supply shocks. I've argued that these bottlenecks are going to be persistent over time, and I'm not going to repeat myself, but I discussed how over the medium term there are 9 separate, potentially negative supply shocks in the global economy, from deglobalization, balkanization of global supply chains, decoupling between US and China, trade wars, aging of populations, restriction of migration, cyber warfare, pandemics, and a fight against income and wealth inequality. They're going to imply that over time, growth is going to be lower, inflation is going to be persistently higher, especially as I argued that monetary and fiscal and credit policy is going to be loose because central banks are in a debt trap. So I see that while consensus believes that inflation by next year is going to go back towards a core of 2% over the medium term, it's not a prediction for the next 6 months, I expect that actually we're going to end up in a world where inflation could be more like 4 or 5%, if not higher, in advanced economies, starting with the United States.
Let's take that straight to the portfolio. The risk reward then in terms of rebalancing. We've seen, as I said, a small equity shift, a small repricing in the bond market to the two sides of the ledger. Do you expect at 5% in inflation then a correction in equities, a more demonstrable shift down in equities, and respectively in bonds as well?
Well, if you think about typical asset allocation, whether you do 60-40, 60 in equity, 40 in fixed income, or 70-30, or even variants of it like Bridgewater's risk parity, the logic of that 60-40 is always based on a world where inflation is low. Because if inflation is low, when the economy is booming, equities are doing well, and the bond market, of course, is not doing well because bond yields going higher and the price is falling. When there's a recession, equity are doing poorly, but bond yields fall and the price of bond goes higher. So there is this negative correlation between bond prices and equity prices. Same thing when there is risk on and risk off. When the risk is on, equity do well, bond do poorly. When risk is off, equity does poorly and bonds do well. Now, think about a world in which there's going to be a rise in inflation. Typical fixed income allocation is long duration bonds, say long duration US Treasuries. You know that every 100 basis increase in long-term interest rates reduces the market price of bonds by about 10%. So if there is going to be a rise in inflation, and this rise in inflation is going to lead to a rise in expected inflation, your typical fixed income portfolio, whether it's treasuries or other variants of it, is going to have subject to massive losses. And if you think about it, we've had now almost 35 years where bond yields have been falling and their price has been rising. So we've had a 30-year bull market in bonds. But that's because inflation fell sharply from the 70s into 80s, 90s, and so on, and is expected to remain around 2%. If I'm correct, that then you're going to have a significant rise in inflation, bond yields are going to be higher, and there'll be a bloodbath in long bonds. Point on bonds. Point on equities is that also equities are highly sensitive to interest rates. We saw it, for example, in the 70s. Today, P ratio for S&P 500 firms around 20 plus. If you look at the Shiller Cape, 30 plus. In 1982, when we had inflation and stagflation, the P ratio was 8. Today is 3 times higher than it was. And of course, any increase in long-term interest rates also hurts equities. And I'll give you just one recent example of how even a small change in long bond rates can impact negatively both your bond portfolio and equity portfolio. Look at what happened in September. In September, there was a minor repricing of bond yields. 10-year Treasury went up, 20, 30 basis points. And what did we have? Significant losses on your bond portfolio and a correction in US equity between NASDAQ, S&P, and Dow Jones between 5% to 8% for the NASDAQ. So you lost money on your fixed income and you lost money on your risky asset portfolio. And this is just for 30 basis points increase in bond rates. Think about if you have 300 basis points increase in bond rates in a situation where inflation gets out of control. Okay. What would happen in that situation?
You've put a lot out there. So I walked away from a cup of coffee with Nouriel yesterday and I went back in time, and it was 1994. So to those of you who are not alive or trading bonds in 1994, I want you to contextualize for the audience. In 1994, the bond market emotionally broke me and ravaged my, my overall exposure. Bond markets moved by 200 basis points and wiped me out.
Yeah.
Can this bond market rise by 200 basis points in yield in a Fed taper and a rising inflationary environment?
Well, I would separate a rise in bond yields that would occur if inflation is higher and the Fed is left behind, meaning they don't react to the rise in inflation by tightening enough, in which case expected inflation is going to go higher and bond yields are going to go higher in nominal terms because of that, separately from a situation in which if inflation surprises on the upside, as I feel it's going to surprise the upside, if the Fed, and that's not my baseline because I think the Fed is going to wimp out, but let's assume for a moment that the Fed tightens monetary policy, then real rates are going to rise. Expected inflation may not rise as much because you're fighting it, but the real rates will rise, and the rise in real rates again implies that long bond yields are going to be higher. So as long as inflation is going to stay higher than expected by the Fed, them if you do and them if you don't. Because if you essentially accommodate, expected inflation is higher, long bond yields are higher, real rates stay low, but bond yields are higher and you have losses on your bond portfolio. And if Fed fights inflation, real rates rise, and you have losses on your bond portfolio and on your equity portfolio.
Let's get some levels out of you then. I mean, for the past 6-7 weeks, I've been looking at real rates at negative 100 basis points. How much can real rates rise in the context you've just outlined?
Well, if the Fed is behind the curve and inflation rises and they're worried that the economy is going to tank because there's already a slowdown of the economy, then they're going to find some excuse to raise rates, in which case expected inflation goes higher significantly, bond yields go higher in nominal terms, break-even go higher, real rates don't go higher. If in fact the Fed really at that point decides to tighten monetary policy, then real rates are going to rise, break-evens are not going to rise as much. So it depends on the reaction function of the Fed.
Okay, let's get a few
But in either way, you get the losses on your bond portfolio.
Either way, there's a bit of pain to come on my bond portfolio.
And on the equity as well.
Okay, I don't know if I can live through another 1994. Thankfully.
Well, in 1994, the Fed was hiking rates in ways that was unexpected, from essentially 3 down to 6, and then bond yields went from 6 to 8, and you had massive losses,
and I agree it was a different context in terms of economics, but it was a bond market which unraveled very, very quickly.
It was a massive rout in the bond market. I mean, you literally lost 20% on your bond portfolios.
Okay. Let's talk about how I can hedge against some of the event risk that you've just outlined. A lot of people come on the telly and they say, oh, I want to be long tips. Do you want to be long tips?
Well, if you're thinking about your fixed income portfolio in a world in which inflation is going to be higher, as I pointed out, long duration bonds, whether they are treasuries, whether they are other advanced economies, whether they are emerging markets, whether they are corporate bonds, all of them, of course, are going to have massive losses, significant ones. So you want to stay away from long duration bonds. Typically, when there is inflation in the fixed income portfolio, there are several options. Option number one is you stay in inflation index bonds that are going to reprice because of inflation. Secondly, it can be in short duration bonds, because if you're in short duration bonds and then interest rates rise, they reprice at a higher level, so you don't get the same losses you get on the long duration bonds. Three, historically, in my view, gold has been a very good hedge against inflation, not just against inflation, against also political and geopolitical shocks, against financial crisis, against even debt crisis. So I think that gold is a good hedge like other precious metals. In my story that I told today, of course, there are structural reasons why energy prices, oil prices, food prices are going to rise as well. So you want to be long overall a basket of commodities as well.
Do you want to be... Sorry, go ahead.
And final point I would make is you want to be also, historically, real estate has done well because it's a hedge against inflation, especially the type of real estate that is in fixed supply. And therefore, you want to be in real estate, but the caveat I make on real estate is there'll be parts of the world and part of North America that are going to be significantly damaged because of global climate change. Literally parts of even United States are going to be inhabitable because they are either underwater or because they are too hot. And therefore, if you want to be in real estate or infrastructures, you want to be in the parts that are sustainable of North America or other parts of the world. So you don't want to be generically in real estate. You want to be in places that are environmentally sustainable.
Okay, there's a lot to unpack there. Parts of North America will be uninhabitable in due course. Let's step back for a moment, Nouriel.
Yeah.
Oil, gas. The average American is now paying 50% more to fill up their car.
Yeah.
Heating oil is going to be darned expensive going into this winter.
Yeah.
How do you want to be... Is this energy crisis going to be long and enduring, and therefore, how do I want to be long into that crisis?
Yeah, in my view, and I started making the argument this morning, oil and energy prices are going to be significantly higher for many years. And the reason is that for the last few years, we all care about global climate change, we all want to decarbonize, but what has happened is that there has been one massive underinvestment for the last 5 years into fossil fuels, whether it's coal, whether it's oil, whether it's natural gas. Financing for new projects that have to do with coal or natural gas or oil are very hard to come. It's politically incorrect. Even big oil that can finance itself has the pressure from their own shareholder who say, stay away from this stuff because you have to go green and so on. So we're seeing now a huge collapse into exploration into new reserves. And as you know, it takes years to explore, to find new reserves, then you have to drill, then you have to pump it, then you have to distribute it. So this massive underinvestment is going to lead to a reduction in the relative supply of hydrocarbons and fossil fuels for many years. At the same time, everybody's talking up green economy and green energy, and I'm all in favor of it. But the trouble is that for a whole bunch of reasons, the supply of renewable and green energy, whether solar, wind, or otherwise, is not rising fast enough. And therefore, what's going to happen? The supply of fossil fuels is collapsing. The supply of green energy is rising less than the fall in fossil fuels. Demand for oil and energy is going to rise in the global economy as there is going to be positive economic growth. And therefore, this is not just a short-term phenomenon due to some kind of market freak or because there's going to be a cold winter in Europe and so on. Look, right now there's an energy crisis, not just in the United States. Look at the UK, where there are petrol stations running out of literally oil. In Europe, where natural gas is now triple in price. In India, where the coal utilities are running out of coal. In China, where there is a power crisis. This is a global phenomenon. And in my view, has to do with the fact that while we all want to decarbonize, and it's a lofty goal, we're reducing the supply of fossil fuels, we're not increasing fast enough the one of alternatives. And by the way, with alternatives, you need just not only to produce them, but also to store them. Because, you know, a lot of it is kind of cyclical, right? Wind is cyclical, solar is cyclical. And we're not yet having cheap storage as well. The other point that I think is important here is the following one. If you really want to switch from fossil fuels to green and renewable, you have to increase the price of fossil fuels significantly. That's the argument that economists make about carbon taxes. But politically, the carbon tax that make sure that we have a switch from fossil fuels to renewable is politically mission impossible.
Do you think there's any possibility of a carbon? Do you think there's any, we're going into COP26, do you think there's any possibility of a realistic, we've just had a global minimum corporation tax. The world is changing. Is it possible that we evolve towards a global carbon tax?
I would say mission impossible. I mean, look at what happened in France. They increased the price of diesel by what, 10, 20%, and you had almost like a revolution with this gilets jaunes in the streets. And we're already having rising prices of gasoline, heating oil, coal, everything around the world. You want to add another 50% to the price to a carbon tax? And that's the minimum that economists believe the carbon tax has to be in order to do the switch from fossil fuels to it. So the rhetoric is all about decarbonizing, green economy, renewables. The practice is that politically, there's no way they're going to have national carbon taxes, let alone global carbon taxes. It's not going to happen, period.
Okay, my inner Bloomberg needs to break out. So we need to understand, people have come and said to me, oh, $100 oil, oh, you want to be long $105, $110 oil. Given the scenario you've just painted to me, talk to me about how much further the squeeze in gas and the squeeze in oil prices go. Will we break $100? Is it going to become the norm over the next 2-3 years? Higher prices in oil?
Well, I'm not an expert in the oil market, but I would say, given current trends, I wouldn't be surprised if, say, Brent, that I think this morning was around 83, is by the end of the year, in the middle of the winter, well above $100 per barrel. I would not be surprised.
So that adds into your inflation narrative?
Yeah, absolutely it does.
Okay, so then...
Because that leads to an increase in headline inflation, and then to second-round effects, it leads to an increase in core inflation.
Can I just clear something up then, which is you're going for higher bond yields, you're going for a slightly higher level of inflation, but you are not calling this stagflationary environment given the growth context that you've just outlined to me, given the demand for commodities. Is that correct?
Well, what I said on stagflation is currently we are in a mild stagflation because there's been a collapse of growth in the United States, a collapse of growth in Europe, a collapse of growth in China. So Goldman Sachs in June was predicting that third quarter growth in the United States would be 10%. Today, I think their forecast is less than 4%, and I think actually the actual number might be 3%. So we've had massive slowdown of growth throughout the world and a significant and persistent increase in inflation. Started in goods, then went into commodities, then went to food, then went to energy. As we reopen, there'll be service inflation. We have housing and rents up through the roof, and wages now are starting to accelerate in Europe, in the United States. And once you get into a wage price spiral, that's when the inflation becomes persistent at the core level.
So then, Nouriel Roubini, given that, we must be in for a heck of a set of tapering and interest rate rises from the Fed. Are we? Will they? Given that scenario that you've just outlined, the dual mandate, as I understand it from the Federal Reserve, is maximum employment and price stability.
Yeah.
To achieve that, what do they need to do in 2022?
Well, the problem and the dilemma, not just for the Fed, but for every other major central bank, is going to be the following one. If you have an aggregate demand shock, say positive, growth is higher, inflation becomes higher, and then you can tighten monetary policy because growth is above potential, inflation above target, and as you tighten monetary policy, you bring back growth to what it should be and inflation lower. Suppose you have a recession, there is a negative aggregate demand shock, again, it's easy. Inflation is lower, you're in a recession, you cut policy rates, you even QE, you go back to positive growth, and you push inflation from zero negative to the target 2%. The crisis and the dilemma is when you have a negative supply shock. Because whenever you have a negative supply shock, inflation is higher and growth is lower. So if you care about inflation, you should be tightening monetary policy, but that crashes growth. And if you care about growth, you should ease monetary policy, but that's going to unhinge inflation expectation and de-anchor them, lead to even higher inflation. So them if you do and them if you don't. And my worry is that we're going right now to a mild version of stagflation, but over the medium term, given this negative supply shock, is going to be an ugly form of stagflation. And therefore, central banks are going to be in a bind. What are they going to do? Are we going to elect another Volcker? It's going to lead to a double-dip recession to break the back of inflation expectation. There is absolutely no political appetite for that, for a Volcker type. And we have midterm election next year in the United States, and Powell has to get reappointed, so he has to go dovish. So between the option of tight monetary policy, crashing bond, credit, equity market, and economy, and causing a recession, and fudging it, and finding an excuse to say it's temporary, and keep on rates lower than otherwise, and doing tapering slower, and causing a rise of inflation, politically, I think the latter choice is the choice going to be made by the Fed and other central banks.
And very briefly then, the fudge is to begin taper and see how we go over the next 6-7 months. Is that the fudge?
Well, you can start tapering, and like it happened, say, in 2015 and 16, they were supposed to start tapering, then there was a worry about hard landing in China in August, September, and then January, February of 16. Then they had to stop it or postpone it. Or as I pointed out this morning, in 2018, they wanted to go all the way to 3.25, and then when the market had a shock, they reversed themselves in a matter of weeks and so on. So if there is a strong market reaction to the Fed exiting their QE or normalizing rates more than they expect, and that market shock leads to a severe shock on the growth of the economy, I think the Fed is going to wimp out and will have to reverse themselves.
Let's define what that shock might be. I think when we caught up yesterday, you said, look, Manus, 40 basis points since the end of August. They've channeled their inner taper to us. Nouriel, what is it that could unseat the trajectory of the taper in terms of a bond market move?
Well, suppose that the inflation by year end is around 5%, core is at 4%, and is not going down, unlike what the Fed believes. Then the market are going to test the Fed. They say, okay, you told us this was a temporary, but it's persistent. Are you going to essentially taper in 6 months rather than 12 months? Are you going to normalize rates already in 2022? And if the Fed gives the signal, no, we're not going to do that, that bond yields are going to go much higher, because right now bond yields are still kept in check, one, by tapering, and two, by the expectation that the Fed is going to be serious about inflation. So the market is going to test the Fed at some point, if inflation stays higher than expected, yeah.
Okay, and let's see when that comes. I mean, nerves may fray. Mnuchin talking about bond yields at 3.5% next year. Do you think that's realistic? Just as
not by next year, but suppose that in the next 2 or 3 years, in my scenario, we get core inflation that goes from 2 towards 4%, and suppose that real yields have to be positive. And by the way, even if the Fed is not hawkish, real yields can go higher, because if you don't know whether inflation is going to be 4, 5, or 6, the inflation risk premia has to be positive. That's why even without a tightening of monetary policy, real rate can rise just because of the inflation uncertainty. That's what happened in the 70s. Then, if inflation was at 4 and you have real inflation risk premia of 1%, then you can have a 10-year treasury at 5%. But it's not a prediction for next year. It's a medium-term story.
Okay, the risk is out at 5%. Translate all of that back to the dollar for me. I had Rabobank with me this morning, and Jane Foley said, it's win-win. I want to be long the dollar as a hedge, but I also want to be long the dollar into a tapering quasi-hiking cycle. How do you look at the dollar? What drives the dollar? Interest rate differentials or something else?
Well, there are many factors that are driving the dollar, and my overall message will be that over the time, the dollar is going to weaken significantly over time. And the story, I think, is based on at least 3 or 4 reasons. Reason number one, in the US, we're running a very large fiscal and current account deficit, huge. It's true that we have also large fiscal deficits in Europe, Japan, and other advanced economies, but these countries are running a current account surplus. In the Eurozone, 2.5% of GDP, while in the US, you have a 3% of GDP current account deficit. 2, the US is a net debtor country. The net foreign liability of the United States are 50% of GDP, while Europe, Japan, and other advanced economies are net creditor. So the structural factors of a twin deficit imply that over time, that large current account deficit should be weakening the dollar. Second, my story on inflation starts with the United States and then spreads to other advanced economies. So if there is going to be any inflation differential positive between US and rest of advanced economies, everything is equal, that should weaken the dollar. Number 3, if I'm right that the Fed is going to try to tighten, but then they're going to wimp out, because with growth slowing down, they risk a recession, and they're going to therefore then give up, that's also a signal that the Fed is not tough on inflation, and that would weaken the dollar. Reason number 4, The US today is using the US dollar as a tool of foreign policy. As you know, it's imposing sanctions against its own strategic rivals, whether it's China, Russia, Iran, North Korea, and it is imposing also secondary sanctions against the countries that do not follow those sanctions. And that means that I was just in Russia, where they've decided, for example, that their main sovereign wealth fund is going to completely diversify away from dollar assets. In China, there is worry that eventually the Cold War is going to lead to the US seizing their treasury. You know, last year, as they were accusing China of having caused the Wuhan virus, some people in Congress said we should not pay the holdings of treasury held by China or freeze them. So the Chinese also are gradually diversifying away from dollar assets. They've gone, for example, into gold. That's why gold went up by 50% between the fall of 18 until middle of last year. So once you use your currency as a tool of foreign policy, people are going to try to diversify away from a dollar-based international monetary system. And as you know, Chinese want to create the ERMB, move away from SWIFT, and create an alternative. Now, I'm not arguing that the US dollar is going to collapse as a global reserve currency.
But I was just about to ask you, say it's going to drop, but we can buy how much?
But everything else equal, if you use your currency as a foreign policy tool, then eventually people are going to diversify away from your dollar assets, and that can also gradually weaken the dollar.
Do you think that's a 5% drop in dollar, a 10% drop in dollar, and if so, over what period of time? If you're going to weaponize a currency, you don't do it overnight, Nouriel.
Well, as I said, current account matters, inflation differential matters, relative monetary policy matters, weaponizing the dollar matters. I would say over the medium term, the dollar is probably between 10 to 20% overvalued, even just based on the current account. So based just on the current account, it should be gradually. As I say, I'm not expecting a collapse of the US dollar. Gradual weakening of the dollar, I would say yes.
One other thing that you mentioned there, you just come back from Russia and various central banks perhaps reducing some of their treasury holdings, which clicks in the back of my mind. If I have inflation, a quasi-stagflation, I have a Fed which is more active. So I'm looking at bond yields clicking higher. How much of a risk to the world is it that central banks reduce their treasury holdings and add to that momentum? Is that a real risk in terms of selling bonds into this market?
Well, I would say if the Chinese were using the nuclear option of totally selling their holding of treasuries that are over $1 trillion, you could have a crash, of course, in the bond market, but that would not be in their interest because there's a massive loss on the market value of those bonds. And the tricky thing, by the way, for the Chinese is that if the Chinese sell dollars and they go into euro and yen appreciate, and then you have a trade friction with them. If you sell your dollar and you go into RMB, the RMB appreciates, and that weakens your export competitiveness. So you have to think about, if you want to sell dollars, what you want to go in an asset that's not going to cause either damage to your own economy or trade friction with other. I think one of the options is gold. And that's what the Russians have done. That's what the Chinese have done gradually over time, certainly between 2018 and 2020. So that might be one of the reasons why, over time, gold will have that upside.
Nouriel, thank you very much.